The bottom line looks great. I'm sure you're absolutely happy with that. But the market, I suspect, is going to pay attention to the cash flow line. And you, like many other oil companies this reporting season, the cash flow line looks a little light. Now, with you, there's a kind of DOJ payment element in that. But even once I strip that out, the numbers still look a little lighter than the market was maybe anticipating. You're going to talk to me about working capital. Explain what's going on here.
So this always happens in the first quarter. So if you look at last year's first quarter, it's the same. So actually cash flow's up versus a year ago. We typically build stocks through the first quarter as we get ready for our turnarounds and refineries. So that builds working capital. Effectively, we're carrying more inventory as we go through the first quarter, as we get it set up for the driving season in the second quarter, particularly in the United States. So typically for oil majors, you'll see working capital build. So it's your inventories. And then that's exacerbated by the price run-up. So, in fact, the value of the inventories you have is now more expensive. Yep. So you typically have a working capital build. If you put that $1.7 billion build on top of the 5.4 op cash, it puts op cash over $7 billion, which for the year puts us on track in terms of fully covering the dividend and the capital program at around $50 a barrel. Net
debt went up a little bit. We got $70 a barrel. Are you kind of a little surprised that net debt went up a little bit?
No, it's followed exactly the plan that we'd laid out for this year. You mentioned it already. It was the $1.6 billion of Macondo payments. $1.2 billion of those related to a DOJ settlement back in October 2012. That was the final, what we call the bullet payment, went out in the first quarter. So as that cash has gone out, we've sort of reached the peak now of quarterly payments for this year in terms of Macondo payments, and that's why net debt rose. It was that plus the working capital build. You'll now start to see that come down as the year progresses quarter on quarter, especially given where prices are today.
If I show you a chart here of your debt distribution, we see on the Bloomberg DDIS is how you get to this function, a lot more debt coming due in 2020 and 2021. How do you want to rearrange this chart in order to make the debt a little bit easier to live with?
Yeah, debt will naturally come down as we go through this year. We've got the plan set up for this year to be break-even at $50 a barrel, and obviously we're significantly above that level right now. The strong earnings, the production growth that we saw come through last year, cash will flow through this year, debt will drop down. In terms of renewal of the actual debt profile that you can see here, we typically have around about $4 to $5 billion of debt roll-off each year, and then we'll go back into the markets on a go-forward basis. We don't need to carry quite such a high cash buffer as we've carried historically, so we'll let some of that debt naturally roll off as we look out to 2020, 2021. But typically we have around about $4 to $5 billion of renewal per year, which is the way we manage it inside our financial frame.
I want to come back to the deep water payments. You made one comment about the DOJ payment. How much more do you expect to pay because of this, and how much have you paid already?
So the total provision is now over $66 billion for the Deepwater Horizon. We still have about $14 to $15 billion of cash to flow. That will now flow over the next 12 years out to 2032. That's under the payment schedules that were put in place back in July 2015. We now have a handle on what that will look like on a quarterly basis. And the only uncertainty now is around about 300 claims out of 390,000 claims that we have within the facility around the court-supervised settlement fund. Those last 300 claims should be determined in the next quarter. But we now have a pretty strong handle on what the quarterly cash flows look like out to 2032.
Did you have to borrow to make that payment?
Which payment?
The DOJ. Just in terms of how the cash flow works.
No, the balance sheet's got quite a lot of flexibility within it. Okay. So we run the balance sheet within a 20 to 30% gearing. So we can let the balance sheet take some of that strain. But a lot of that was dealt with a long time ago with the $70 billion disposals that we did. Okay. So if you recall, back in 2011, we funded our balance sheet initially around $10 to $20 billion worth of disposals. We did another $50 billion on top of that. So we've effectively sold off the equivalent of a sort of mid-sized oil and gas company over the last 5 years.
Talk to me a little bit about Russia. We've obviously seen a considerable amount of disruption in the aluminium market. People are concerned about the nickel market. Have you seen any concerns? Have you had any expressed concerns to you? Do you have any worries about that Rosneft stake? Is there any feedback that comes back the other way from that Russia story?
No, at the moment we're working within the sanctions framework that we have, and nothing's changed in terms of that. And the relationships with our partners on the ground are pretty good. So we continue to work with them within the framework that we have. We stay very close in terms of what the various moves are around sanctions, and we'll continue to operate within that framework. And I think with Russia, clearly tensions are quite acute right now with different parts of the world and the geopolitics around that. And I think it's at moments like this where businesses can provide a two-way communication between those locations, and we try to do that, but so far nothing's changed in terms of where the sanctions are.
Brian, you're spending right now you have $500 million penciled in for renewables. I'm wondering how that budget changes as the industry kind of grows so rapidly.
So we've laid out actually a framework of $200 to $500 million. Last year it was close to $500 million. I think it was $450 million. We've laid out 2 weeks ago a framework around reduce, improve and create low carbon opportunities. In the low carbon space, the opportunities we'll pursue will be anchored within our existing divisions. So some of the things that we're doing around fast charging, for example, at retail stations, we'll look at what opportunities come up, and we can ramp that investment up and down, but it has to be within our disciplined capital frame of $15 to $17 billion. And we think we can accommodate the $500 million in the current frame today.